We have just received new signals from the Fed themselves on their intention to significantly slow down the economy. And in today's video, I'm going to be walking you through why I believe that a hard landing is still much more likely than a soft landing, with charts, with data, and with Fed commentary. Look at this. US rates, they may be heading higher than what you or Wall Street is thinking. Now, 6 months ago, I was in the camp that the Fed would not take the Fed funds rates much over 5%. But with the sticky inflation data, the very strong jobs report, at least on paper, I'm starting to believe that the Fed could take Fed funds rates to 5.5% or the upper 5% in order to slay inflation. Look at this. Fed's Mester says that she saw a compelling case for a half-a-point rate hike. That means there are Fed committee members who believe that the Fed is not moving fast enough to take down inflation so that it's not entrenched. Now, before we get into the rest of the video, make sure to follow me and my friends on Substack, where I also provide investment strategy, thoughtful previews, and insights. Links in the descriptions below. In one of my recent emails, I talked about this related to what Fed governors are saying. Look here, Fed Governor Bostic says that higher peak rates are now on the table. Fed Governor Kashkari says that rates could be heading to 5.4%. Fed Governor Waller says that rates could go higher than expected. And then Fed Governor Williams says that rates could be in restricted territory for a few years. Now, you might be wondering, why does it matter whether the Fed funds rates is at 5%, 5.5%, or 6%? Does it really make all that of a difference? And the answer is absolutely. Look here, total household debt, it reaches $16.9 trillion in the fourth quarter of 2022. And we can see because of this, mortgage and auto loan growth is slowing down dramatically. If we take a look at this table, we're going to see debt across all line items: mortgage debt, home equity line of credit, student debt, auto debt, credit card debt, other. All of these line items have increased in value since the fourth quarter of 2022. This is an important table to pay attention to. Look at this table. It conveys the delinquency rates year over year from fourth quarter of 2021 to fourth quarter of 2022. If we look at these line items, every single line item is essentially going higher. Mortgage debt delinquency rates are going higher. Credit card debt delinquency rates are going higher. Auto loan debt delinquency rates are going higher. Across the board, we're seeing delinquency heading north. This is a recipe for disaster if rates continue to go up from here, which I just showed you is the Fed's intention. Look at this. These high-income earners now are moving back into their childhood bedrooms and putting off vacation as inflation drags on. In fact, almost 2/3 of US consumers, they're living paycheck to paycheck. Let me know in the comments below what you think about the local economy right now. Every time I go out with my family or go out with my friends, it seems that people are flush with cash. People are doing so great. People are spending lots of money. I personally don't understand it because we can see here that 2/3 of US consumers living paycheck to paycheck, and a significant portion of them are making over $100,000 a year. Now, if we take a look at this anecdote from the Wall Street Journal, I believe that it's representative of a lot of the good folks that are out in the US right now. We've got Mr. Vasquez. He's 34 years old. He's living in Philadelphia. He was able to save some money during the pandemic, grew his balance from $4,000 to $20,000 in early 2022. But because of the inflation situation, because of the rising cost of everything, his savings have pretty much dwindled to $2,000. And I believe that this story is represented in a lot of American households in the US. It's just not being reflected in the stock market for now, but that could change according to what I'm about to show you here. Look at this. Global liquidity drain. It's coming from markets, Citi's King says. So far, in the last couple months, we've seen a $1 trillion rise in central bank reserves, boosting risky assets. So what we've seen so far is the ECB, the BOJ, and the PBOC, which is the Bank of China, having their liquidity injections put into the system. But with their injections most likely done, all eyes are on the Fed and what they plan to do with their balance sheet. Now, why does this matter? You might think. Look at this. Central banking liquidity. It's a term we use to describe deposits of financial institutions at the central bank. It's synonymous with reserves or settlement balances. The more liquidity there is, the greater the deposits there are, and the more money there is in the system in order to buy assets. Now, one of the major catalysts behind the 2023 rally is this liquidity from the central banks. Look here. The origins of this year's risk rally lies in obscure technicals driving central banking liquidity. And as King says in his report, at this point we think most of the boost to reserves is done. This implies that the story for the rest of this year should return to one of liquidity drainage and risk weakness. And one of the conclusions from Citi's research is this, that a $1 trillion increase in reserves is about a 10% boost in stocks, 50 basis points of tightening in investment grade credit, and 200 basis points of tightening in high yield spreads. And it is the actual addition or removal of such liquidity and not just its announcement which causes markets to move. On a side note, at the Fed, what could make the tone a little bit more hawkish from here is that Biden is going to name Lael Brainard, who is currently the vice chair, as his top economic advisor. And at the Fed, up until this point, Lael Brainard has pretty much been one of the strongest doves on the committee. And now that she's going to be on Biden's economic advisory team, there is a potential that the Fed's committee decision-making spectrum is going to tilt a little bit more hawkish later this year. You might be wondering, well, that still doesn't explain why the markets have been so strong in 2023. Well, look at this. The fund manager surveys from Bank of America says that a lot of positioning continues to still be on the sidelines, and for that reason, there's money to buy dips and there's money to buy retracements, and so far, that explains why the markets have been so resilient, added on with liquidity. Now, before we jump into the rest of this video, I want to take a moment to thank our sponsor, Brilliant, for partnering with us today. Now, one of the things that can add value to your career is by leveling up your skills and knowledge. And that's where our videos partner, Brilliant.org, comes in today. Now, if you're looking to get more technical with finance, you would want to build on your math and computer science skills for advanced analysis and modeling. And what is a good resource to dive deeper? Brilliant.org. With Brilliant, you'll be able to quickly acquire and perfect the necessary skills to understand analysis and models to an even greater extent. For example, the Math for Quantitative Finance course talks about financial modeling, risk, all things that I talk about and look at regularly in my analysis of the market. Brilliant can also help you get up to speed with its fun, bite-sized, and interactive lessons to get to that next level of understanding. Brilliant also offers courses in data science and software development. So if you've ever wanted to lean on the quantitative side of finance, these courses can help you advance your investment strategy that way. Brilliant is the best way to learn interactively. It has thousands of lessons from foundational to advanced math and data science, with new lessons added monthly. To try everything that Brilliant has to offer for free for a full 30 days, visit brilliant.org/Larry or click on the link in the description below. The first 200 of you guys will get 20% off Brilliant's annual premium subscription. With that said, now I want to show you a very important statistic. See here, the typical American homeowner has about 70% of their net worth tied up in their primary residence. And so housing is the nest egg for most Americans. And a crack in this nest egg will have tremendous negative spillover effects. Look at the survey here. Majority of professional investors expects U.S. homes to drop by more than 6%. In fact, 20% of investors think that there could be a double-digit decline. Now, if any of this actually materializes, meaning a 6% drawdown in housing or a double-digit decline in housing, well, given that, as you can see here, most American homeowners have 70% of their net worth tied up in the primary residence, we're going to start to see the wealth effect start to spread into consumer consumption behavior. On top of this, most investors, they expect mortgage rates above 5.5%, and they see the chance of it going above 6%. About 27% of professional investors see this happening. Because mortgage rates have come down recently, we're looking at housing trends start to seem a little bit more favorable for buyers and sellers. But as we can see from the data, sellers are still reluctant to list their homes right now, which is keeping a floor on prices. We can see this from the number of newly listed homes, and that's declined significantly year over year. So sellers are being less active in the housing market, thereby keeping a floor on prices. A secondary data point to look at is the median days on market for homes, and we can see that since mid-2022, this chart has ticked up substantially, meaning the real estate market is starting to become less liquid. Well, you might wonder why this matters. Well, look at this. The longer the homes spend on the market, the more time and control buyers have. And homes have been on the market for a median of 44 days, ticking up from about 20 days in mid-2022. The opportunity to sell home prices above list prices is also quickly fading. Now, do I believe that there will be a national housing crash across the US? Not necessarily, but it's going to be a region by region consideration. Look at this chart here. There's a lot of outbound activity from California into states like Florida. So certain states in the US are going to have more pronounced drawdowns in housing prices than others. And so for now, real estate is likely to be a region by region consideration going forward, dependent on corporate hiring and layoff decisions in that specific area. Let's take a look at the equity markets when it comes to the housing sector. I'm going to show you some data related to home builders, home improvement, the transaction marketplace, and then rental landlords. Look at this here. The home builders ETF is pricing in optimism of a soft landing. Look at the technical setup. It's staging a recovery, but in my opinion, I think it's too soon to tell that the home builders are going to see a sustained recovery, especially if the Fed is going to lift rates to 5.5%, maybe even the upper 5% later this year. I think that this is a more realistic chart from Home Depot, which represents home improvement. Home Depot has remained flattish as housing is in a wait and see mode. I more or less agree with Home Depot's outlook rather than the home builder's outlook. Look at the transactions marketplace as demonstrated by Zillow and their stock. With mortgage rates now under 7%, we can see that the affordable part of the market is healing. And so Zillow is attempting a counter trend rally. Once again, I don't think that this rally is the beginning of a new bull market in housing. Time will tell. If the Fed funds rates is going to go to 5.5% or 6%, I have a very difficult time believing that the housing market is going to stage a remarkable recovery. Now, this chart here from Avalon Bay is, in my mind, one of the clearest demonstrations of a weak consumer in the US. Avalon Bay is one of the largest rental landlords in America, and we can see here the chart that demonstrates lower lows. This technical structure is the most convincing one to convey how the housing market and their health is at this very moment. So out of these four setups within housing to convey the economy and the housing market, I more or less trust Avalon Bay the most. It accurately tells us that the challenges on the ground for housing is substantial. Now, I'm not necessarily recommending any of these stocks here. I'm just using the equity markets for the housing sector to understand how investors are looking at different areas within the housing spectrum. Now look here, I recently said on Twitter that the bond market is bringing up the 2-year yield to 4.6% to indicate higher for longer. Now the stock market is now also projecting incredible optimism for a soft landing between 4,100 and 4,200 on the S&P 500. And these two markets, they say completely different things. And in the end, in my opinion, only one will be correct. I'm going to be studying inside my community the top 25 names inside the S&P 500, the top 10 names inside the Dow, the top 25 names inside QQQ, and the top 10 names inside KWEB and the SOX ETF to really understand the fundamental direction of where the market is headed. So I'm going to be doing a lot of research. Make sure to join my Substack email list down below for public insights, free previews, and more strategy and research. With that said, guys, I will see you in my next video. And thank you to Brilliant for sponsoring today's video.